All right, future CPAs, let's get right into it. We're talking about one of the biggest, baddest topics on the Philippine CPA exam, the cost of equity. Seriously, this thing trips up so many people. But guess what? Not you. Not after this. We're going to crack this thing wide open together.
And I'm not playing. This is like a boss level on the board exam. So many people wipe out on this topic and lose crucial points. But in the next few minutes, we're not just going to help you understand it, we're going to make sure you absolutely master it. For good.
Okay, so first things first, let's build our foundation. Before we even think about touching a formula, we got to get the main idea down solid. I promise if you nail this part, everything else is going to click so much easier.
So let's switch hats for a second. Imagine you're an investor. You're about to put your own hard-earned cash into a company. You're not just doing it for fun, right? You expect something back. So my question to you is, what's the absolute bare minimum return you would demand to even consider it?
Boom. That right there, that minimum demand is the cost of equity. But here's the key. You have to see it from two angles. From the company's perspective, it's a cost. It's what they have to pay to get your money. But from your side, the investor's side, it's your required return for taking the risk. It is the same number, just seen from different points of view. Super important to remember that.
Okay, ready for our first major tool? Let's dive into the Gordon growth model. From now on, when you see a problem mentioning dividends, your brain should immediately think of this model. It's all about figuring out a company's value based on the dividends it pays out and, you guessed it, how fast those dividends are growing. First up in our formula, we have D1. And listen up, because that little 1 is everything. It means the expected dividend for next year. This is a classic LECPA trap, for real. They'll give you D0, which is last year's dividend, just hoping you'll use it. Don't fall for it. You always have to look forward and calculate what's coming next.
Next, we've got P0. This one's pretty easy, thankfully. It's just the current market price of the stock. Like, if you were to open an app and buy it right this second, that's the price you'd pay. Simple as that.
And the last piece of the puzzle is G, the growth rate. Now, we got to be real. The Gordon model makes a huge assumption here. It assumes that the dividends will grow at this one steady, constant rate forever. Yeah, forever. It's a big assumption, I know, but for those big, stable, mature companies, it actually works surprisingly well.
So let's put it all together. The cost of equity, or K, equals D1 divided by P0 plus G. So what does that actually mean in plain English? Well, it's just the dividend yield. The dividend you get as a percentage of the price, plus the rate at which those dividends are growing. That's it. So simple, but so powerful.
Okay, I need you to screenshot this slide, highlight it, do whatever you need to do because this is a huge exam topic. So look, when a company uses its own money, its retained earnings, the formula is just how we learned it, no problem. But if they issue new stock, they have to pay fees, right? For bankers and lawyers and all that jazz. We call those flotation costs. This means the company doesn't get the full price for each share, so we have to adjust that price, P0, downwards. And basic math tells us if the number on the bottom of a fraction gets smaller, the final answer gets bigger. So the cost of new stock is always higher.
All right, let's switch gears. The Gordon model is awesome, but only for companies that actually pay dividends. So what about a hot new tech company that's reinvesting every single peso and pays 0 dividends? What do we do then? Well, that's where our second major tool comes in, the Capital Asset Pricing Model, or CAPM. And this one is all about risk.
So what's the big idea behind CAP? It's actually pretty simple. The more risk you take on, the more return you should expect to get. But, and this is the whole point, CAPM is super picky about what kind of risk it actually counts. It only cares about the risk you absolutely cannot run away from no matter how much you diversify your investments. We call that systematic risk, and it is the star of this show.
Okay, the first piece of the CAPM puzzle is the risk-free rate. This is our starting point, our baseline. It's basically the return you could get on an investment that's considered totally 100% safe, the ultimate safe bet. Just think about government bonds. It's the return you get for taking pretty much 0 risk. Right, so if you can get a guaranteed safe return, why on earth would anyone risk their money in the stock market? Simple, for the chance to get an extra reward. And that extra bit, that's the market risk premium. It's the bonus return you demand just for being brave enough to jump into the market instead of playing it safe.
And now for my favorite part of the formula, beta. Honestly, the easiest way to think about beta is as the stock's vibe. Is it dramatic or is it chill? If a stock's beta is exactly 1, It just moves along with the market. If its beta is more than 1, it's extra dramatic. It soars higher when the market is up and crashes harder when it's down. And if the beta is less than 1, you guessed it, it's more chill. It's less volatile than the overall market. It's all about the vibe.
And here is how we put all those pieces together. The cost of equity is just the risk-free rate plus the stock's beta multiplied by the market risk premium. So think about it like this. You start with the safe return, and then you add a personalized risk-reward based on that specific stock's market vibe. That's CAPM in a nutshell.
So remember how I said that CAPM is really picky about the kind of risk it cares about? Well, this next part is the reason why. Understanding the difference between these two types of risk is like the entire secret to unlocking CAPM. Let's break it down. Okay, here's the deal. The entire world of finance just assumes you're a smart investor, right? And what does a smart investor do? They diversify. You don't put all your eggs in one basket. So, because you can protect yourself from one specific company failing, CAPM basically says, hey, that's on you. We're not going to reward you for taking on risk you could have easily gotten rid of. The market will only compensate you for the risk you absolutely cannot run away from.
And this slide lays it all out perfectly. On one side, you have systematic risk. This is the big stuff that hits everybody, like a global pandemic or a huge economic recession. You can't escape it by diversifying. This is the risk that beta measures. On the other side, you have unsystematic risk. This is all the company's specific drama, like a product recall or some bad management. You can totally protect yourself from this by owning other stocks. And because you can avoid it, CAPM completely ignores it.
Okay, you've learned the models. Awesome. But let's be real. The real challenge is making sure this information is still fresh in your brain on exam day, right? Better yet, how do we make this stick for the next 3 years and beyond? That's what this final section is all about.
First, let's do a quick-fire bullet review. Get ready to screenshot this. Gordon Growth Model. Think D1 over P0 plus G. That's your go-to for dividend-paying stocks. And please, please, please don't forget about flotation costs for new stock. Then there's CAPM. That's your risk-free rate plus beta times the market risk premium. This is your tool for a pure risk-based view. Got it? Good. Burn these into your brain.
Now for the real magic, the hacks to make the stuff stick for years. Hack number 1, teach it. Find a friend, a family member, anyone who will listen, and explain these models. If they get it, you've truly mastered it. Hack number 2, localize it. Forget the boring textbook problems. Go look up a real Filipino company you know, like Jollibee or SM, and calculate their cost of equity yourself. Make it real. And hack number 3, storytell it. Turn the variables into stories. How did a certain stock's beta play out during the pandemic? What's the latest news on the risk-free rate? I promise you, stories stick in your brain way better than raw formulas ever will.
So there you have it. We have covered a ton of ground, but really, your learning journey is just getting started. You now have 2 legit, powerful tools that finance professionals use every single day. So I'll leave you with this one question. Now that you have the tools, which Philippine company are you going to analyze first? Go on, pick one. The real learning happens when you start doing it yourself. You've got this.